I don't know if
I don't know if I can let anybody in.
Hey, good afternoon. Sorry I'm a couple minutes late here.
So Bob, we are recording the meeting right now, so it is live.
No, I can't find anybody. There we go. Okay. I gather we are recording. Is everybody here? I can't see a waiting room and I'm wondering what's going on.
Christy's trying a different link, so if she doesn't get in, we'll be okay. But it shouldn't hold us up at all.
Okay. So I just got right on, but maybe I'm important or something. I am looking at the agenda right now, and let's do the call to order so that we are official here. And then I would like to do a roll call of everybody who is here, especially the members of the board. And I am Bob Stevenson, chairman, and I am here, although it says I'm a guest, so at least I'm here. The next members.
I'm Jim Phelps, member of the board.
Yes.
Rita Russell, council liaison.
Yes. Christy Kiesel? Am I saying
Yes.
that right?
I am here with Paul Wood from GRS Consulting.
Okay. And Paul is here. Sean is here.
Point of information, does anyone know if this board has a recording secretary?
I don't believe we do. I think Jackie has turned on the recording and she holds those recordings as the minutes.
I'm taking the minutes right now.
Pardon?
I'm taking the minutes for today,
Okay.
since Jackie's not on the call today.
Okay, Sean. Great, thank you. And Shelley Fritz is here.
Happy Valentine's Day to everyone.
Thank you. Yes, And that reminds me that I have a 5:15 dinner reservation, so we are ending promptly at 5. Okay, that completes. And Jackie Lowe is here as another staff liaison from the finance department, correct, Jackie?
Correct.
And Garrett?
Present.
Great. Okay. Before we go to the new business, I would like to move the approval of the minutes up to this point. Does anybody have any objections to that? Could I get a motion to approve the minutes, or if somebody has any adjustments to the minutes, would you bring them forward at this time?
Jim Phelps speaking. It showed John Moore as present at our last meeting. He was not. He's a previous board member, but was not at our last meeting. At least the copy of the minutes that I received showed him as member present. With
Good.
that,
Thanks for catching that. I did not catch that. And
I
I'm
saw
trying
that
to
also.
Find that.
with that exception, I
Yeah,
move to approve the minutes.
Great. Yes, I see that now, and he was not here, and we should update that. Thank you. Does anybody else have any updates? I believe the rest are here. Do I have a second to approve the minutes?
This is Shelley Fritz-Pelly, and I will second the motion.
Thank you, Kelly. Do we let us let us say all in favor, say yay. I'll get it out there.
Yay.
Any,
Yay.
anybody disagree with this? Speak now or forever hold your peace. The motion is carried unanimously. Now, let us go on to the new business. We have a new member. And pardon me, is that you, Garrett?
Yes, it is.
And I am not familiar with having to swear anybody in.
Bob, actually, I have the oath that Jackie provided to me. She wanted me to swear them in on her behalf.
Great, great.
All right, Garrett, if I can have you repeat after me. I, Garrett Brooks,
I, Garrett Brooks,
do solemnly swear or affirm
do solemnly swear or affirm
that I will support the Constitution of the United States,
that I will support the Constitution of the United States,
the Constitution of the State of Colorado,
the Constitution of the State of Colorado,
and the Charter and ordinances of the City of Inglewood,
and the Charter and ordinances of the City of Englewood,
and that I will, to the best of my ability,
and that I will, to the best of my ability,
faithfully perform the duties of the office as a member
faithfully perform the duties of the office as a member
of the Non-Emergency Retirement Board
of the Non-Emergency Retirement Board
during my continuance therein.
during my continuance therein.
Great, congratulations, you are now a member. And I will send this attestation for you to sign as well.
Fantastic. Thank you very much. Glad to be here.
Good to have you. We appreciate your willingness to serve.
It's my pleasure.
Thank you. The next item on the agenda is the consolidation of pension boards. Sean, was that your report, or where are we going with that?
This is actually Tamara Niles, City Attorney.
Okay. Tamara?
Yes, thank you. Most of you, if not all of you, should have received an email from me regarding a project at the city to consider consolidation or potentially elimination of various boards in the city. During this project, we looked at how many boards the city has and how many boards other cities of our comparable size have. What we found is we have sometimes 10, 20 more boards than other cities our size. So we started looking at why. One of the reasons why is because we technically have a separate board for multiple different pension and disability funds within the city. Those, of course, are NERP, the firefighter pension fund, the police pension fund, the volunteer firefighters pension fund, and the police and fire supplemental disability funds. So those are all separately existing boards under our municipal code. NERP is the only board that meets regularly and has really worked to develop an expertise in pension, retirement plans, and you're the only one that's fully staffed as well. I believe you're fully staffed at this point with the swearing in of the new member tonight.
Yeah.
And so it's been difficult for us to get members for some of the other boards, especially the police and firefighters. Those are called old hire funds. And the firefighters code requires us to appoint city firefighters. But as you probably know, we don't have a fire department anymore. We contract with Denver Fire. So we are proposing that NERP and the other boards consider consolidating into a single board under NERP. Essentially what we're looking at is, or what we're proposing is that NERP consider adding an agenda light item for these other boards and possibly adding a few more members, perhaps a retired member of our fire department, possibly retired member from police. And then if any issues should come up regarding those boards, then you already have a scheduled meeting and it's already on your agenda line item. What we found is these boards have not met in quite some time other than NERP. And so I don't think it will take much extra work on NERP's behalf. But the first step is bringing it to you and seeing what you think. Are you open to it? If so, then we will continue exploring it.
I will entertain any discussion, but I personally am more than open to it. Anything that will streamline anything in the city and cut red tape and make things easier to do, I'm in favor of. I did know some of our former firefighters who retired about the time I did, and I might make some suggestions on that. Rita?
Thank you. Tamara, do you know if any of those boards have any members?
Yes. The firefighter pension board has 2 non-city members and 2 vacancies. And those are retired firefighters now. Police pension board has same 2 members that aren't city employees and 2 vacancies. Police Fire Supplemental Board has 1 non-city member and 4 vacancies, including 2 that are supposed to be elected from our fire department. That's the one that's really difficult for us.
Okay, thank you. I appreciate that. And is it possible? I mean, I know each of these boards runs a little bit differently than this board. And I mean, we have an actuarial, that I know the police has their own actuarial. And so I think we need maybe some history, before we just go forward with this. I absolutely agree that they need oversight. And I think that this would be a great board to do that, but I also think it would be wise for this board to make sure we have all the background information that we need to make sure that we have everything.
Could I make the suggestion, Tamara, that we schedule this discussion for next meeting and perhaps set a goal of accomplishing this, I guess you'd call it a merger or consolidation by the end of the year, if that would make any sense. That would give us time, Rita, to explore all of the contingencies, and I think you've probably been doing that, Tamara, but we need to catch up. So is there any other discussion or anything that anybody else would like to suggest?
If I could weigh in in
Sure.
response to Councilmember Russell's question, it's my understanding that the other boards have not been able to get quorums because they don't have qualified members. So the history and what they've been doing, we don't have good records on that because they haven't met in quite some time. So it's a bit of a gray area for us. But I'm happy to get the last minutes and any information I can from city staff from our records.
I think that would be a good idea. I don't know that I want to wait till the end of the year to do this because the lack of oversight on those boards. But I also don't want any liability to this board. So, and I mean, is it possible to schedule an extra meeting with you, city attorney, so you could explain to us?
Well, let's look at it this way then. At the next meeting, we would at least have a discussion and plan on voting, and maybe between however many would need to have input or would like to have input, we could either schedule a meeting. I don't know what the legalities would be. Tamara, you can probably tell us on that. If we needed to have a meeting to discuss it so that it would be on public record, I would be open to that. If this was just considered preliminary discussions and we could do it, at a convenient time, I would be open to either one.
Yes, we should do it in a public meeting if it's the entire board or even a majority of your board. The procedurally, NERP is not required to vote on it or really even consider it. But before I started working on it more, I wanted to get a general thought from you. The procedurally to make this happen, it's an ordinance from city council.
Okay.
But
Okay.
I don't think city council wants to make you do anything that you don't want to do or that you have reservations about.
And I do not have many reservations. I just think that we need to move forward on it. And I'm anxious to hear if we have any other opinions on it.
I think Paul has his hand raised.
I'm not seeing it.
So
Sorry,
I'll just,
Paul.
no
Go
problem.
ahead.
Just make a quick comment. One of the, there's quite a bit of difference between, I think, what this board does and maybe what those other boards do. Whereas this board is really responsible for hiring that actuary, hiring, Innovest and investing those assets. Whereas those other plans are covered by FPPA. So they're getting all that administrative stuff is done by FPPA. So it doesn't seem as though it's quite as hands-on, for this particular board, for those boards that they really, I don't want to say they do anything, but, a vast majority of the heavy lift is done by FPPA, and then they provide those reports to the city so that the city knows what kind of contributions they would need to make. We are also the actuary for the FPPA, so we have a pretty good idea of what's happening there. So we just wanted to put that out there.
Great, and that would clear that up. If you're also their actuary, you could report here, so that would seem to be a natural fit to me. And Tamara, correct me if I'm wrong. This is only the second time I've heard about this and talked about it, but the police board is actually duplicated the state. The police are now under a state plan or something greater than that. So that board seems to be rather unnecessary anymore. Am I wrong on that?
So this is called the Old Hire Police Pension Board. So it's
Okay.
before it went to the state. And Paul, thank you for your comments, because that was a concern of mine and other city staff, is that city staff gets these reports. But we want a board or some sort of oversight to look at them and make sure there's nothing of concern. Right now we receive them and that's it. And so we would like to attach them to the NERP agenda, just so there's some oversight and it's public and everything's on the up and up.
Great. How many old hire retirees are there under that plan? Do you have any idea?
I'm going to ask Sean Weisky if he knows, because I don't have those records on me.
I didn't think you would really, but I'm just wondering, because there can't be too many there, I don't think, but I don't know.
And I don't have those numbers off the top of my head, but I can certainly get those for consideration.
Great. If you would do that and maybe send it out, that would be great. Paul?
I can let you know. So right now we've got in the old hire police plan, there's as of last year, 33 members, old hire fire, 36 members, and there's also a small volunteer group of 3 members.
Okay. So we're affecting about, what, 69 members by doing this, correct? Something in that range anyway. Great. That's good to know. Anybody else want to weigh in?
Paul answered my question for us, so that would be, I was just wondering how that would work with the money aspect in that. So thank you, Paul, for answering that.
Well, Tamara, do you need a motion from us to move forward, or is this enough just to give you the consensus of the board?
I'm comfortable without a motion. I feel like I've received some direction as to additional information you need, and I'll reach out to staff to see if they can get perhaps some minutes of prior meetings of the other boards, if we have any, to see what type of action has been required. I also do have some analysis from outside counsel. We retained outside counsel to evaluate all of this and recommend this. And this is one of the things they recommended to improve efficiency. So I will plan to create a packet of additional information to help guide you. And then if you do want to vote, perhaps next meeting.
That would seem a good path to follow. Paul, is your hand up again, or am I? Great. I thought it went off and then I saw it come back, so. Great. Okay. That being taken care of, I would like to go to you, Paul, for the actuarial valuation report. And I think it's plural now. Would you just go ahead with that?
Absolutely. Well, I know that the chair has dinner reservations, so I'll try to keep my comments under an hour and a half. But no, what we're here for, I hope can everyone see the screen just to make sure? I'm not very good at Microsoft Teams, but I think you should see our presentation.
Yeah.
Great. So what Christy and I are here to present are the results of the January 1, 2022 valuation. You may think to yourself, wow, that was a really long time ago, and it was a really long time ago, but we struggled a little bit with getting data last year, so it set the schedule back a little bit, but it's still important that we talk about that particular valuation because the results of that valuation set the contribution rate that should be in effect here in calendar year 2023. And so Christy and I are going to talk again about what happened as of that valuation date, but then I'm also going to talk just for a moment about what happened in 2022 that could affect the valuation that we are working on right now. And so we'll jump in with some of the highlights. I'll go through this slide and then I'll pass it over to Christy to go through some of the details. But there's a couple trends that are really starting to stick out. First of all, active population is continuing to decrease. So we're down to 68 active members. We were well over 100 members a few years ago. So we're seeing this continual decrease in membership. What that typically would mean is that when we do this calculation of a contribution rate, we're making contributions based upon a rate of pay. And so if pay keeps decreasing and we're saying we want, say, 30% of pay, but pay is down 15%, then we're going to get about 15% fewer contributions than we would have expected. And so that's something that we need to keep an eye on. And if it continues to happen, then we may have to talk about some strategies to address that in terms of getting contributions into the plan. So we're really closely monitoring that. In terms of that actuarially determined contribution or the contribution that needs to be made here in calendar year 2023 to the plan, that total amount decreased to 25.2%, down from 30.8%. We net out the employee contributions and we're left with a city portion of 22.2% of pay. So a nice reduction year over year. Christy's going to talk about some of the reasons for that. But don't get too excited because, as we'll get to at the end, because of the results of the capital markets in 2022, that rate's going to go back up here when we do the valuation we're working on right now. Talking about investment return, again, very stale numbers because this is actually calendar year 2021, about a 14% return on your market value of assets. So beating your expectation of 6% by almost 8%. So, just a really strong year. And then we're going to present a lot of these results on what we call the smooth value of assets or the actuarial value of assets. And we expect that asset value also to return 6%, and that actually returned 9.8%. So again, another strong year for the actuarial value of assets. Finally, the funded ratio, which is the ratio of our assets to our liabilities, increased to 85.5%. So, again, as of this day, if we were sitting here a year ago having this conversation, we say, boy, things are really looking good. But again, I just want to temper that just a little bit because we had a really challenging 2022. And with that, I'm going to pass it over to Christy to go over some of the details for us.
Thank you, Paul. So we're just going to jump right in with starting with some of your plan membership data, really focusing on what's happening with the active members. Over the year of 2021, we saw 1 age retirement, 2 drop retirements. Along with that, we saw 15 terminations and only 10 new members. So from all of that, you can really see that the rate at which members are leaving the plan is a bit quicker than they are entering the plan, which is contributing to this decrease in active population that Paul mentioned on the previous slide. Along with that decrease in the active population, we're seeing a decrease in that payroll. So over the year of from 2020, January 1, 2021 to January 1, 2022, we saw about a 6% decrease in payroll. And that is also then going to impact the amount that's being contributed to the plan. As Paul mentioned, the plan is contributed to as a percent of pay. This also includes employees contribute to the plan at 3% of pay. So when there's less payroll, there's less contributions coming in. So we just really wanted to highlight again how steeply that active population has been decreasing. That it was up over at 159 just about 12 years ago compared to 68 members in 2021. So along with that, the average service in the plan is remaining approximately stable. Your active average age is a little bit lower, and that's due to some of these new members coming in a little younger and some of those older members aging out. A couple other numbers to look at here. We can just see that those members in payment status stayed relatively stable. So we saw about one age retirement from active membership. We also saw another retirement from our deferred vested members. And then we saw a couple of deaths over the year that were balanced out by a few new beneficiaries, overall remaining stable. Those deferred vesteds, these are the people that left the plan that had enough service to be vested that are expected to be paid benefits at a later date. And that went up a little bit because 5 of those 15 other terminations were new deferred vested members. Overall, the total participation in the plan decreased a little bit, but remained relatively stable. And then at the bottom there, you can really see that sharp decrease in the annual payroll, even though that average pay per member did increase. So on our next slide, we are going to take a look at these market value of assets. As Paul warned, we need to tamper the excitement on this slide a little bit. The numbers were really good. We came off of 2 really strong market value years. So 2020, 11.6% rate of return and almost 14% in 2021. We're not expecting to see that. We're actually, Paul's going to be going over this a little more later, but we actually are seeing about a negative 11% return in 2022. So that makes these results a little bit outdated at the moment. But another couple of key things we can look at on this slide are those member contributions that Paul and I were talking about. Is that you can see the member contributions decreased a little bit. That's going to be due to the decrease in payroll. All members are still contributing at 3%, but with less contributing, that amount's going to go down. With that going down, the city contributions are increasing as they're going to have to make up for some of that lower contribution overall. The benefit payments are increasing. There were a few more people getting benefit payments. Along with that, some of the people retiring are receiving higher benefit payments. So that becomes a greater need to be able to contribute to continue to pay those benefits long term. So we'll move on to the next slide, which this is our actuarial value of assets. So all of our calculations are actually going to be based on this value, which we consider a smoothed value. So we're really taking those market values and we're going to take any gains and losses from year to year and smooth it over 5 years so that the funding decisions we're making for the future of the plan are not based on these really volatile market years where we're going from a year of 14% rate of return down to negative 11%. Instead, we're working on this more smooth value where we have our actuarial value of assets over 2021 returned a value close to 10%. And this is because we are recognizing those gains from actually the last 3 years of really impressive asset returns. 2019 was about 17%. So we're recognizing a chunk of that in this, along with the 11% from 2020, and then that 14% of 2021 is all currently getting recognized, little pieces of it in these actuarial value of assets, which allowed us to have a gain and return 9.8%, a little bit over that 6% assumed return. And that is that gain of 1.3 million. If we take a step back, we can see that that value is a little bit lower than that 14% from 2021, but it's still a little bit higher than our return. And then what we're going to see moving forward in 2022 is that this actuarial value, although we are expecting to see a little bit of a loss, it's not going to be the quite large gut punch that is returning 17% less than that 6% we were expecting. So that is really the purpose of using this actuarial value of assets, and overall seeing all of those prior gains and getting to recognize them in this figure really helps us moving forward to be able to make solid funding decisions based on a more stable value that's not as impacted by all of that volatility. So next, what are we funding? We are funding this actuarial accrued liability, and over the last, well, from over 2021, we saw a decrease in that liability from 47 million down to 46.3 million, which was actually about $576,000 less than we expected. And the primary source for those gains is due to some of your withdrawal experience. So we're not seeing people staying in the plan as long, and therefore they're not accruing as much liability as we were expecting them to over time, which has been really helpful. We're also seeing some members that we would be expecting to retire staying in the plan a little bit long, which means they're continuing to contribute to their future benefits, and that is helping to decrease some of this future liability. So from year to year, we can see that we've actually seen gains on this, on the accrued liability over the last 2 years. And that is, it's mostly due to some of those expectations being not exactly as we imagined. So that's actually really good for the plan. And in a greater scheme of our gains and losses here, if we go on to our next slide, we will see the bigger picture of gains and losses over the year. So in 2021, it was a big gain year on both that investment return and our liabilities. So as we see, that investment return was a really, really big part of the gains over the year. That's that 1.3 million gain on the actuarial value of the assets. So that's the biggest portion of the gains to the plan over the year. And again, just to tamper expectations, we're not expecting to see those same gains in 2022. From that last page, we'll see the next biggest chunk is due to that demographic and liability gain. So that's just due to membership changing a little bit differently than expected and in favor of lowering the liabilities for the plan. This last little line item is due to cash flow and timing. This really just has to do with how we are assuming the timing of payments such as payroll and benefits to come through the plan versus when they're actually paid out. And so there's just a little bit of gains and losses that we see that fluctuate from year to year, but overall it's a really small piece of this gain loss puzzle to the plan. So
Christy, I'll just jump in real quick, just to provide a little bit of context here. So what this is effectively saying is that, Christy and I, we have these expectations on the liability, we have an expectation on the assets, and we do this little bit of what we call like a gain loss report card that says how close were our expectations. Then can we explain why our expectations weren't met? It's actually my favorite part of the valuation. And so this is measuring up against what we're doing. And so what this is kind of telling us, at least on the demographic side, we have a couple years in a row here where we've seen these demographic gains, and it's mainly driven by that termination experience. So again, we have this like sort of churn on our active member population, we have a lot of people terminating, or more people than expected terminating, releasing a fair amount of liability. So what this tells us is that, at some point here, we're going to need to start looking at that termination assumption to see if we're being a little bit too conservative with it potentially. But at this point, not too concerning, but something that we are keeping an eye on.
Thank you, Paul. So with that, I'll have Paul take us to the next slide, which is really the culmination of our report. And this is really one of the main reasons that we're here today, is to give you this information, which is what needs to be contributed to the plan and how do we come up with that number. So as Paul went over in the very first slide, the final outcome here is actually a decrease in the determined contribution for the city from 27.8% down to 22.2%. And this contribution amount is made up of a couple of different pieces. The first piece is the normal cost, which is the cost to replace each member in the plan. So it's the cost of the benefit for the members in the plan. This is the value of the benefits. And then we are going to take out from that normal cost, we are going to take out the expected member contributions, which is that 3% of payroll. And then so that leaves us with the city's normal cost. So the part that the portion of the benefits value that the city is providing to the member. And then the final piece is the amortization payment. And this is a really large piece. And this is just taking the unfunded accrued liability, which is the amount that is the difference between our actuarial accrued liability, which a couple slides back was about 46.3 million. So we're going to compare that amount, that liability that the plan needs to pay, to the actuarial value of assets, which is about 39.6 million at the moment. And so the difference between those two amounts is going to make up our unfunded accrued liability. And that amount we are then going to spread as a payment over time, and that is going to be our amortization payment. And that created this final number here, which is the largest piece of that city determined contribution, which then gets us to our final actuarial determined contribution of 22.2% of payroll. So then if we take a look at the final slide, this is just really to let you guys know how the contribution has changed over time. So we're looking at a snapshot of about 10 years here, and you can see that up until this year, that amount has been continually increasing, and it has been both due to so you can see we have it broken out into two pieces here. So the bottom piece in the kind of gold color is our normal cost percent. So that's the value of the benefits to the members. And then the larger green chunk on top is that amount that we are paying in order to pay down that unfunded accrued liability. So over the last 9 years before 2021, we saw a generally steady increase in that unfunded liability, which also meant that we were seeing a steady increase in that amount that needed to go toward paying off that unfunded liability. At the same time, we were seeing the benefit value increasing, which together made the entire contribution increase over time. Now we can see this year in 2021, due to really positive investment returns, as well as gains on that liability, we saw a decrease in that unfunded liability, which helped shift that total determined contribution down, which again, to tamper expectations, I would expect these lines to go back up a little after this next year, primarily due to our investment returns. However, at this point in time, I can't speak to what we're going to see in terms of liability gains and losses. So that might help here or there, but overall, we would expect to see this number rising again after 2022.
All right, well, maybe we'll pause there. And are there any questions on either the liabilities, the assets, this contribution rate? One of the things that goes through my mind when I see something like this is, wow, there's a lot of volatility here. So is there something we should be looking at to address the volatility? We do have some smoothing techniques that we're using already, but it just happens when you're coming off this really long string of decent years. This is a result of the funding policy. And so the city could look at this and say, well, maybe we just want to keep our contribution, up at the level that it was at, for another year, because we know it's going to go up next year, or drop it down to that 22.2%. And then, with the expectation that it probably is going to go up when we look at the calendar year 2024 contribution rate. But we'd be happy to take any questions before we get to the projection part of the presentation.
Paul?
Yes.
Would the council make that decision or approve that decision? And maybe Jackie can answer, would the finance department actually make that recommendation?
I'll just give my comment real quick. I think what the 22.2% represents is the minimum amount that needs to be contributed according to the funding policy. I don't believe there's anything keeping the city from contributing more, but I'll defer that portion of it to Jackie.
In terms of formal process, I'm not quite sure if we need to get a council's approval. I would say our city's contribution has been pretty stable. Like for 2023, we decreased by $300,000 because the market performance and the termination of the employees. So I cannot answer in terms of formality about council's approval. Yeah, but I do have a question for Paul. What does the UAL stand for?
UAL is unfunded accrued liability. So that's the difference between the liability and the assets.
Okay. Yeah, I think council has been approving the city's employers' contribution through the normal budget adoption process. These numbers fluctuate depend upon the market performance, and it differ again, like Paul stated. Yeah, Councilmember Russell.
Let me ask you this in another way. Is this something that we as a board could contribute to or make a recommendation to, or is that part of our purview?
I feel this requires bigger conversation because Paul, you are going to share with us how many years would take city to pay down liability, right? I remember probably 14 to 15 years. And do we want to pay down faster? Is this necessary? I feel our funding ratio has been pretty healthy. So.
Yeah, oh yeah, go ahead, sorry.
I just would like to share some historical. I think the reason Paul is here is to inform us and let us know. I know that when John Moore was on this board, he was an actuarial also. And I think the recommendation comes from the board, what we want to do, how we set things, and then the city has to incorporate that in their budget. So, and Paul, maybe you know more how that works, but I think this board recommends what we ought to do.
Yeah, that's been typically the experience here. And what we've done is, if you go back and look at some of the history, we've changed what we call that funding policy, or the mechanism that we use to come up with this contribution amount. And you really do have a pretty strong funding policy. It's something that back in 2020, we put into place where we had a big pile of unfunded accrued liability at that time. And we said, we're going to amortize that particular piece over a 15-year period. And so that will be paid off over 15 years. And then each year going forward, if we have these, what we call those gains and losses, so if we do better than we expected or worse than we expected, then that particular gain or loss would then be amortized over a 10-year period, their own individual 10-year periods. And so the funding policy in and of itself is very strong. It's just creating a fair amount of volatility because we have relatively short periods, 10-year periods. That's one of the best amortization periods that I have as one of my clients. So very happy to see that. But because it is a shorter period, you do get some of these fluctuations year to year. And so if you just allow the funding policy to work out, you'll see, you'll have the contribution come down this year, and then next year it'll go back up, and then the year after that it could start to fluctuate again. But the funding policy, if we just follow it, we're going to get to where we want to go. That's for sure. But again, does the city want to contribute that amount, and is that that's really up to them ultimately. But I think the board in the past has said we're going to set the contribution calculation this way, and this is what we approve. And then I think the city has gone along with that and has actually contributed that amount, at least in the history that since I've been around since 2015.
Great.
And I'd like to add to that a little bit. I do think when the city, because it may have been back in 2020 or 2019, when we changed it and the city really didn't have the funds to contribute as much as they wanted, I think the board changed their mind to amortize it over 15 years instead of 10 years. So I think it kind of can be a give and take.
Yes. I think from my dim memory of all of the history, I think that is correct. And I was following it from afar, to put it mildly. So that's what I wanted to clarify. Thank you, Rita. So now are we moving on to this last report, Paul?
Yep. I'll move through this pretty quickly, and then if there's, I know we're kind of, getting strapped for time here. So what we'll do is I'll go through quickly, and then maybe at the next meeting, if we want to drill down and spend a little more time on it, we certainly can. But
okay.
One of the things that I do want to always get across is that these valuations are at a point in time. And so it's just taking the information right on that date, said, what's the assets in the bank at that point? What does the liabilities look like at that point? And that's very important, but it's also important to understand where we're heading. And so what I did here on this long-term projection is I looked at what the employer contribution rate, how that's going to materialize over time. And I started with the line that I presented last year, which was the 1/1/2021 valuation, which was that purple line. And it showed that we were going to start about, that 27% rate. And then it was going to come down a little bit, sit around 20%, head back up. And then ultimately, when we have all of our unfunded accrued liability paid off, we're going to be contributing somewhere in the neighborhood of 8.5%. That's down to the 2036, 2037 arena. The green line is this year's valuation. You can see that it's significantly lower than it was when I presented last year. And that's a direct result of the investment rate of return coming in at that 13.8%. And so what I did, I just recast that purple line to say, okay, what would happen if the return was 13.8% in 1 year, just to show you that there's consistency in the projections, and that what's really driving this train here in these projections is that 1 year's return. In a moment, I'm going to get to what this looks like if we recognize the 2022 actual rate of return. It doesn't look as great as here, but we'll move on to the dollar amounts. Again, dollar amounts are going to be, we're projected to be lower if we had a 6% return going forward. And then when we look at our funded status, and I think this is what's most important, this shows that our funding policy is working. This shows that, it doesn't matter what the investment rate of return is, we're going to calculate a contribution that's going to put us on a path to get to that fully funded point somewhere in the neighborhood of 2035. And so this helps me sleep at night to say that, boy, we've got a really good plan in place. It's going to put us on a path to being where we want to be in a very, very reasonable period of time. Just again, to touch on that 2022, just as an estimate, I plugged in negative 10.86%. I think that I just received the audited assets 2 days ago from Kevin Engels at the city, and the return was actually somewhere like the return that I would calculate was somewhere in the neighborhood of 10.4%. So this is just a little bit more pessimistic than that. But what this is going to say is that we've got some deferred asset gains that Christy talked about. So that's going to help offset some of this poor performance. But if we don't have any future overperformance, if we don't have anything coming in above 6%, then things are going to, that contribution rate is going to tick up quite a bit. And that's what you see here. So the purple line is that the valuation with a 6% 2022 return. And then the red line is the same valuation line, but with a negative 10.8% 2022 return. And you can see that there's going to be this upward pressure on that contribution rate over time. We could potentially eclipse 40% of pay in 2032. And again, this is absent any overperformance whatsoever. And so that's where we could be headed. We look at it as a dollar amount. By 2034, 2035, we could be looking at somewhere in the neighborhood of $1.75 million as a contribution. So about double of where we're at today. And then again, the slide that shows our funding policy working as we would expect it to. You can see that funded ratio growth in the first few years, because of that poor return, is mitigated somewhat. So we've kind of stayed where we're at. And then we have this little drop off in 2027, but then we're right back on track to get to very close to fully funded by 2035. And again, this is your funding policy at work.
That's very positive. It's actually fantastic, I think.
Yeah, the board did a lot of heavy lifting the last couple of years, especially in 2020 when we changed that amortization period to do that 15-year amortization period, but at the same time, we really strengthened our mortality assumption. We went down to a 6% discount rate. You have that's pretty much the best discount rate of any of your peers in pretty much in Colorado, but certainly in the Denver sort of metro area. So there's a lot of heavy, hard decisions that have been made, and so now it's just a matter of let's let this play out and let's make sure that we make the contributions. Let's make sure that everyone's aware of where those contributions are going to be, and then we can plan accordingly. But we have a plan in place that's going to put us where we want to be.
Yeah, I think we owe a lot of gratitude to John Moore and Jim Woodward for setting this up, because I feel like I can just kind of coast, and they really understood what they were trying to do, especially John. Thank you. Do you need more time? Where are we?
I am all done if there are not any questions.
Great.
Paul, yeah, sorry. I have a quick question and comment, Paul. If I just want to know assumption you use to do the long-term projection. We are targeting 6% as the return on the actual value of assets, right? And you're thinking you might increase the termination rate based on the current situation. And what's the estimated annual salary increase in your projection? Like 3%, 4%, or 5%?
Yeah, it's somewhere in the neighborhood of I think it's around 3% is what I have plugged in there.
Okay.
And so what would happen if we don't see that 3%, then we might see that rate of pay increase a little bit higher, but that rate of pay times the slightly lower payroll would end up in about the same amount in terms of dollars. So that's one of the nice things about these projections is that we do get that give and take there. When you look at it, it could be a little scary as a rate of pay, but then when you look at it as a dollar amount, it's much more palatable.
Yeah, because we're conducting a class and compensation study, so we might change some employees' pay to reflect inflation. So that might be another variable that will play in your projection. Just want to throw this out.
Yeah, and so what would happen in a situation like that is we would see these pays increase, that accrued liability number would go up, but then over time, because we're now working off a higher payroll base, if we get 25.2% of a higher payroll base, we're going to have much more money coming into the plan that's going to pay off that increase that initial increase in the accrued liability. And so it doesn't end up being a complete wash, but it's pretty close to it, as you ladder out that projection 15,
If we
20 years.
see the whole thing in a 15-year time frame, not just
Yeah.
1 or 2 years, then get
Exactly.
nervous. Yeah.
Yes. Yeah.
Okay, thank you.
Great, thank you, Jackie. Well, I think we're in a good place, and if we need to drill down more, as you put it, John, Paul, we can do that next meeting. But I think I understand, and I think the board understands where we are, and that's the main thing. And we're now caught up, which is even better. So we know where we stand. So that's great. I appreciate all the work that you and the staff have done. Thank you.
All right. Well, thank you. And if it's not evident, I love to talk. So if you want me to come back in May at our next meeting and talk about anything else, more than happy to.
Yes, it'd probably be good to count on that, and then we will, if we decide we don't need to or whatever, we'll let you know. But I think it would be good because we're really just getting a snap overview of actually two full years. So there might be some more that we need to look at. Thank you. Great. Now, I think we need to turn to the nuts and bolts. We need, I don't think we have any guests or anybody who is looking to comment on anything, do we?
I have no comments or anybody prepared to make a comment.
Hearing none. Let us move on. Do we have a Gabriel Roeder Smith and Company?
Nope, that's me again. I've said enough.
Okay, that's what I thought. Thank you. Do we have any need for retirement approvals or notifications? I am not aware of any.
We don't have any right now, although we did just get a couple of requests. So the next board meeting, I anticipate we'll have a couple.
Great. Thanks for that heads up. I'll be in touch and we'll look at that as we get closer and put it on the schedule. Okay, let's look at the nuts and bolts. Wendy, are you here? And what do you have for us so we can continue on here?
Wendy is not here. Stephen Fraley is here from Innovest, so I'll be
okay, Stephen,
presenting the performance report and then discussing our long-term outlook for making some potential asset allocation changes to the portfolio.
Go ahead.
Great. Let me share my screen, and I know we're fighting a battle of time here, so I will spend just a couple of minutes reviewing performance for last year. Paul and Christy did a great job of reminding everybody of the really strong performance. Of course, we had in 2019, 2020, and 2021. Unfortunately, 2022 was a challenge with higher interest rates, bringing down both stocks and bonds throughout the year. Can everybody see my screen there?
Yes.
Excellent. So quick performance summary. In the fourth quarter of 2022, the portfolio is up about 5.5%. Nice bounce back compared to the first 3 quarters of the year, which saw negative returns in each subsequent quarter. That brought the total calendar year performance for the defined benefit plan to minus 10.7% for the calendar year 2022. Certainly a challenging year. Never like to see, those types of losses, down 10.5%. But considering the landscape, considering what traditional stocks and bonds did, we're pretty happy with that result. Ending market value as of 12/31, 37,179,861. Quick update, 2023 has been a strong start from both a stock and bond standpoint. So the portfolio is up about 5.5% through yesterday to start 2023. So continued strong momentum that we've carried forward to the new year. Briefly looking at the allocation as of the end of the year, that's the table on the far right. You can see the asset classes listed, the total market value allocated to each of those areas, the current allocation as a percentage, and how that compares to the long-term target allocation. All in all, plus or minus, 2% roughly across all those different asset classes. So I'm pretty happy with where things are from an allocation standpoint. And to keep things moving, I'll just quickly touch on the major indices. Of course, as I mentioned, difficult time frame. We finally did see some positive returns in the fourth quarter. Those are those blue bars that are actually above the line for once in 2022. So strong bounce back across equities and fixed income. Unfortunately, for the full calendar year, you can see those green bars below the line. Equity markets down between 15 to 20%. Core bonds, or just kind of traditional bonds, down about 13%, which is, the worst performance we've seen basically in bond market history. And then just to show a comparison of kind of what a traditional stock and bond portfolio did, a 70% stock, 30% bond portfolio was down about 17% in 2022. So I think, again, taking that back to the city's performance down about 10.8%. Pretty happy with those results and the job that some of those alternatives and diversifiers did in the portfolio. So in lieu of time, I'm going to skip forward a couple. Yep. Sorry. Do we have a question there?
No, I just wanted to compliment you that you have met your goals of not losing so much in a downturn and keeping what we've got. I'm very, very happy with this. Thank you.
Well, appreciate that perspective. And I know it's never easy to still see, a 10% plus loss. But again, I think relatively speaking, considering what other parts of the market did, we're pretty happy with the results. So thank you for that, Bob. So moving forward, just again, kind of in lieu of time, we'll skip past some of the asset allocation and policy summaries because we will be talking about a new potential asset mix. So my apologies as we skip through to some of the kind of key fiduciary takeaways. Right here on the manager scorecard, there were a few changes throughout the quarter that I wanted to touch on. So again, this highlights any changes across management teams, personnel, performance concerns, any other concerns that might be popping up throughout the quarter. So you do see a few blue boxes there. The first one there under people, 3 lines down, Harbor Capital Appreciation. This is actually pretty unfortunate. One of the co-portfolio managers, Sig Sigalis, he's actually the founder of this strategy, actually passed away towards the very end of last year. Certainly surprising to us. There's still 3 other co-portfolio managers that are actually managing the day-to-day assets and making allocation decisions, but we certainly wanted to bring that forward as something that we will continue to monitor on a go-forward basis. So very shocking and certainly sad news there, and something we wanted to bring to the group as a minor concern. Again, doesn't change our thoughts on the strategy, but wanted to bring that forward. 2 other additional updates. Asset base, which is about halfway over and about halfway down. You see a blue box for PIMCO. That's the Dynamic Bond Fund. They had a minor concern for asset flows. So they have seen some assets flow out of the strategy. Actually, a lot of those have gone into kind of the flagship strategy called PIMCO Income Fund, which we may want to talk about here today. All in all, this strategy has done a great job from a performance standpoint, but did want to make note of some flows coming out of that particular investment. And then lastly, performance, that's the third column from the right, about a third of the way down. American Funds Euro-Pacific Growth Fund. We did just downgrade that from a performance standpoint based on some recent performance, though we still think, again, this is a high conviction manager, and I'll talk a little bit. Really, they had some exposure to emerging markets and China equities specifically, which have hurt their performance in the last 12 to 18 months. As a result, that's brought down some of the long-term performance looking back 3 to 5 years. Still, if you go out even further, 7 to 10 years, still a really strong performer overall. But kind of part of our process and going through this is if we do get to a point where we see performance start to underperform on a 3 and 5 year basis, we at least want to make sure we understand why, of course, and bring that to the committee's attention, but not recommending any changes at this time. Then skipping to performance, I think quickly, just very high level, mixed bag of performance. Of course, traditional stocks and bonds had a very challenging year. That's kind of the common theme and main takeaway across 2022. So you can see, looking at the year-to-date column here, across a number of the different strategies. For example, Dodge & Cox, that's a large cap value manager, was down about 7% in the year, whereas the higher growth focused managers like Harbor Capital Appreciation were down significantly more. But of course, that's also why we allocate to these different managers very prudently and want to preach, of course, diversification. International managers, again, challenging year, kind of across the international markets, down between 17 and 27%, in line kind of with their benchmarks. And then flipping to the top of the next page, really kind of focusing on fixed income because there are a couple of changes we are recommending as part of the asset allocation tweaks. So you can see 3 different managers that we're allocating to in fixed income. Dodge & Cox Income, which is kind of the more primary core fixed income manager, performed nicely compared to the benchmark, down only 10.8 versus the benchmark, which is down 13. And then PIMCO Dynamic Bond Fund and JP Morgan Strategic Income both outperformed quite dramatically. These two are very different managers compared to Dodge & Cox. They are much more defensive in nature, much more short term in terms of the underlying bonds they're purchasing. They also have a wider mandate, meaning they can kind of go a little bit broader in terms of the assets that they want to invest in and the underlying securities. So both of those held up quite nicely. So when you kind of roll all the fixed income returns together, down about 9.2% compared to the aggregate bond index or core bonds, which is down about 13%. And then really where we get into the diversifiers that did really well, relatively speaking, and really helped the portfolio from a performance standpoint. Floating rate loans down about 2.4%. We are actually going to recommend getting out of this asset class entirely, primarily because these were really used as a protection against rising interest rates. We've seen rates come up dramatically. The 10-year Treasury went from 1.5% to nearly 4% today. So we do think a lot of those, kind of interest rate risks have been mitigated. And so we are going to recommend actually getting out of the floating rate vehicle and actually kind of reallocating those dollars across more traditional, higher quality fixed income. And we'll touch a little bit more on that briefly, but really kind of the better performers, real estate, principal U.S. property fund, up just over 4% during the year. If we flip to the next page, some of the other diversifiers that did well, Ironwood, which is the hedging strategy, really nice kind of calendar year, down only 1.25%. Again, compare that to stocks and bonds. Other real assets that are more inflation sensitive and protect against inflation, midstream energy up 22%. Diversified real assets up 4%. And then towards the bottom, private equity up about 1.5%. So all in all, total portfolio performance down 10.7% for the calendar year. And then you can see, looking further out, even with a really poor year, some of those longer term numbers, again, still look pretty strong going back to 2005. So I'll just pause and see if there's any questions on the report itself. And then I'd love to spend, I know we only have, 13 minutes here. I know everybody's got Valentine's plans and I respect that, but we want to go through kind of our outlook, or at least a summary of our outlook, and then talk about some potential small tweaks to the portfolio, if that works for the remaining kind of 10 minutes or so. Does that sound good to everybody?
That's great.
So I will move forward accordingly, but as a quick recap, I kind of mentioned this, but 2022, hard to recap, of course, in just a handful of bullet points. There was a lot of headline news, a lot of activity, but really the underpinnings of everything that we saw had to do with this inflation that had been building up in our economy as a result of exponential government spending after the COVID crisis. This led to increased demand for goods and ultimately led the Federal Reserve to try to combat inflation by raising interest rates at the fastest pace in over 40 years. As a result, stock market saw its second bear market in less than 3 years, with global stocks ultimately falling about 18% in the calendar year. This also had a dramatic impact on the bond market, as rising interest rates are generally a negative for bonds, especially when they happen as quickly as they did in 2022. So we saw the aggregate bond index fall 13% in the year, which is the most we've ever seen in modern bond market history by multiples. I think the worst previous bond market for a calendar year in modern history was down 3.5% for the aggregate bond index. So almost 4 times worse performance. The one silver lining was that diversification outside of stocks and traditional bonds did help mitigate risk. So again, those alternatives, some of the real estate, the other real assets, and the hedging strategies really did their job in 2022. Quickly, just to reiterate that, this is looking at what we call the table, a periodic table of returns or investment quilt, and just shows different kind of patches on the quilt that represent different asset classes and the calendar year returns, again, kind of ranked from top to bottom across each of those. The one steady kind of stream here is that diversified portfolio in black is kind of always in the middle from a return standpoint, never the best, never the worst. But when we look at that over long periods of time, what that means is that because that volatility has been smoothed out, it allows those returns to compound over long periods of time. And so looking to the right, you can see that diversified portfolio did about 7% per year over the last 10 years, second towards the top in terms of returns, with volatility or standard deviation towards the bottom here on the right-hand side. So that's the goal of diversification, of course, over time. It never feels great in the moment. When stock market is roaring, your diversified portfolio is going to fall behind. And even in years like 2022, you're still going to probably see losses when there's a lot of bad markets. But when you look over long periods of time, that diversification really, really helps smooth those returns long term. And so quick summary of our outlook, again, looking forward, we think the risks of a recession have risen, certainly, as a result of substantial tightening by central banks around the world, though a lot of the information we're seeing coming out in terms of data, in terms of labor market, in terms of payrolls, are pointing to, actually the possibility of kind of avoiding a recession. So, not sure when or if we'll go into one, but recessions are normal. They're part of, again, the normal economic cycle, and they ultimately do set the stage for the next period of growth. So I know that's certainly something top of mind. The odds have increased. Again, we're not making any predictions, but we want to be prepared in case we do go into a recession and be ready for that rebound when it happens. We do believe that stocks anticipate a brighter future long before it becomes clear in economic news. So generally speaking, the stock market bottoms or hits a low point 6 to 9 months before economic data kind of hits a low point, and we see kind of economic data start to turn around. So we do recommend staying invested in equities and remaining diversified, as we always have. Number 3 is probably the biggest impact on future returns, and that is we had a very painful bond market experience last year with rising interest rates. The one kind of positive that comes out of that on a go-forward basis, bonds look much more attractive because interest rates are significantly higher. So we do have much higher expected returns for bonds over the next 5 to 10 years. And then number 4 here, we did talk about potentially here reducing hedging allocation and real estate allocation. In your particular portfolio, you have a lower allocation to hedge fund strategies at 10%. So we're actually recommending slightly bumping that up. This is more geared towards clients and portfolios that had 15 to 18%. We are recommending coming down closer to that kind of 12% range. The reason being is, if you recall, the reason why we wanted to get into these strategies is to kind of outperform bonds over a full market cycle. Now that interest rates have come up, that ability to outperform significantly has been reduced quite a bit. Similar to real estate, we are going to recommend reducing real estate exposure from 7%, where the current target is, down to about 5%. So in lieu of time, I'm going to skip forward a couple of pages. I think that the key when we look forward is still the fight against inflation. We're kind of seeing contradictory news flow out there. For example, we are seeing that inflation did peak in the U.S. and now the January year-over-year number came in at 6.4%, off the high of 9.1% that we saw back in June. But we're also dealing with a very tight labor market, which could lead to kind of sustained higher wages when we look at worker compensation. So some challenges here. One of the stickiest components generally of inflation and the most resilient is wage growth, because it's really hard to go back on wage growth unless there is a more severe economic outcome, like a recession, that would potentially reset a little bit of that labor force. So that's kind of the challenges that we are dealing with. Inflation certainly is in a downtrend. We're continuing to see that, but still a long way to go to get to the Fed's 2% long-term inflation target, certainly. One thing that we saw in 2022 is that equity valuations came down quite a bit. Really, that was just a result of prices coming down. So it's kind of a reset of valuation. So on a go-forward basis now, equities look a little bit more attractive than where they were certainly coming into 2022. And then really the big impact I mentioned, bond returns. Because interest rates are higher, we really do expect future returns to be much more attractive. And we do want to talk about potentially utilizing what we'd call a multi-sector bond manager to help take advantage of the market and take advantage of reduced interest rate risk. And so we would consider adding a new bond manager, PIMCO income fund, and potentially shifting some of the allocation of the current bond managers and the floating rate loan allocation that I mentioned to this new manager and to other parts of the bond portfolio. So I know we're running up on time, so I'm going to skip forward to spend the last few minutes on the actual study itself. And so again, I think we've got a couple new faces since this time last year, but to reorient everybody, this is the asset allocation study for the city of Inglewood. And focusing on the top left-hand side, this time last year when we had this conversation, you can see the different asset classes listed from top to bottom. You can see the IPS column here, and then you can see the expected return of 5.41%. To earn that 5.41% over the next 5 to 10 years, you would have had to take some risk. In this case, you could experience a drawdown of up to 17% in any 12-month period. Again, that's the risk that you could potentially have to experience to earn that, call it 5.5% per year. Again, this was what we were looking at coming into 2022. Fast forward to 2023, based on equity prices coming down, valuations coming down, based on interest rates moving up, and the future for bonds looking better, we've revised our expectations upwards, which also reflect, of course, a poor year in 2022. So for that same portfolio, if we shift to the right, that darker blue column that says IPS, same allocation, you can see we would expect that portfolio to now earn closer to 7%, with that same downside risk of a potential decline of up to 17% in a really bad market environment. And then So what we've done from here is kind of show 3 different alternative mixes with varying kind of stock, bond, and alternative exposure. And I'd like to just kind of focus everyone's attention on mix 1. I think that, makes the most sense. It's very similar to the current return expectation and risk of the current portfolio, but does include some of those slight tweaks that I mentioned previously. So the one thing that you'll see that's been completely omitted is floating rate corporate loans. We had it a 5% allocation. We are, again, recommending removing that allocation completely and really kind of spreading that out into domestic fixed income, adding a little bit to low correlated hedge, and adding a couple of percent to private equity. So kind of really spreading that out across traditional fixed income, low correlated hedge, and private equity. And so in doing so, if we look at mix 1, you can see very similar return expectation with that same downside risk of 17%. So I think that's kind of our recommendation, is to focus on that mix 1. But I'd love to just pause here and see if there's any quite immediate reactions or concerns with that recommendation. And again, happy to talk more about our thoughts on floating rate corporate loans. Again, we kind of think they've done their job in a rising interest rate environment. As a reminder, those do invest in below investment grade quality bonds, so they do carry a little bit more risk. And now that interest rates have risen dramatically, we think it makes more sense to kind of spread that allocation around into other areas of the portfolio that we think are more attractive going forward.
Do we have any discussion, Jim?
No discussion. I was ready to make a motion, Bob.
Yes, go ahead.
I move that we accept Innovest's recommendation for mix 1 for 2023.
Do I have a second or any discussion?
Bob, I do have a question for Steve. Quick
Sure,
question.
yes.
For
Yes.
2022 IPS, I didn't see large cap, but 2023 IPS, I saw 21%. How does that balance?
Yes, I'm sorry, Jackie. I noticed that too. It must have gotten cut off on the reporting. So our apologies. So that is basically just an error on the reporting formatting. So that 21% here, large cap equity, is what Jackie's referring to, should be listed over here above the small cap mid cap US. So that's just a reporting issue. I apologize for that. I noticed that too walking through. So thank you, and we'll make sure that gets corrected.
Okay, thank you.
Jackie, do you have any other comments? I mean, my basic instinct is that this is the way to go. I'm thinking that you would probably see things that we might not. What is your reaction?
Definitely, we want to listen to the professional. If they had a performance as we desire for 2022, we'll move forward with their recommendation for 2023.
Great. That's my thinking also. Jim, is your hand still up, or I'm looking for a second to your
No,
motion?
my
Right.
hand should be down.
There it goes. Thank you.
Waiting for a second.
Do we have a second?
I will second it.
Great. Jackie will second. Any further discussion?
The only thing, oh, sorry. Nope, go ahead.
Whoops. Oh,
sorry. I interjected mistakenly. Go finish your motion, please. My apologies. I got a little too antsy.
We're getting there. I'm getting antsy too. All in favor, say aye.
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 Any opposed? The motion is carried unanimously. Now, you have the floor, Steve.
Okay, I just wanted to take another 30 seconds. So as part of the implementation, and thank you for everybody's support of mix number one. We did want to make some slight changes to the underlying managers within, say, fixed income. I'm not sure if that needs a board approval, or I can double check the investment policy statement to see if underlying manager changes do require board approval, or if Innovest does have discretion there. So it would be within the domestic fixed income asset class. I mentioned the PIMCO income fund, and we did include some materials, so I don't want to spend the time. I know we're at the top of the hour, but basically we are recommending reallocating two of the existing fixed income managers, the PIMCO Dynamic Bond Fund and the JP Morgan Strategic Income, and reallocating those dollars, which make up about 3% of the portfolio, into PIMCO income, which we believe in this environment is a more prudent decision, and can exercise their ability to see what they like in the bond market, and make those allocation decisions themselves. So it's kind of more of an implementation decision within fixed income itself. And I'm happy to send more information or follow up intra-quarter, whatever, again, you guys think is most appropriate. I don't want anyone to feel rushed.
In looking over this, I think you have that discretion. Jackie, you may have more input into that, but right now I would be open to at least letting you proceed. And if we have to take a vote, maybe we could do it remotely or something like that. Is that okay?
Yeah, and we can follow up. So we can still move forward with the allocation change that was voted on to that mix one. And the implementation piece can always come later. So we can double check the investment policy statement and make sure of that. I don't want anyone to feel rushed. And I'll follow up with an email and just stating, hey, here's the section of the IPS that says we can or we can't. And then if we can't, we'll follow up and find the best way to resolve that.
Great.
Does that work?
Great.
Great. Okay, that's it from us then. Thank you, everyone.
Thank you. I appreciate your consideration also. Let's see. Do we have any old business? I don't think so. I think we've taken care of everything. Any other discussion or issues that we need to look at? Rita?
Thank you. I just have a question. Belinda Porter, I thought she was still supposed to be on the committee. And we had changed the meeting to 4:30 because she cannot, I mean, she has to leave work early, but she can't leave any earlier than to be here by 4:30. Was there a reason that we changed back to 3:30, or was it only this one meeting?
Well, I'm open to that, but when Jackie and I were discussing that, right now it's just for this one meeting, but Jackie's told me that she did not reapply. And so she is no longer a member of the board.
Did she get a notification?
Yes, she did. In fact, I sent a follow-up myself. So I don't know what is going on. If you know her or are in contact with her, could you follow up or maybe talk to Jackie also about this issue?
Jackie McKinnon?
Yes.
Okay, yes, I can talk to her. Are we still one person short?
You know, I thought we were up to our quota, but I'm really not sure now that you mention it, if Rita's not, or if
Belinda?
Nita's not here. Okay?
Okay, I will check with her and then we'll just go from there.
Check with Jackie and I will check with her too, and we will
Okay.
get this straightened out.
Okay, thank you.
Thank you. The chair Chair will entertain a motion to adjourn.
I move to adjourn.
Thank you. And I appreciate all your considerations. Thank you very much. And with that, we are adjourned, and happy Valentine's Day, and hope you have a great evening and do something romantic.
See you
Bye-bye.
later.
Thanks,
Bye.
thanks
Bye.
everyone. Appreciate it.
Bye.